video. You see my screen? Yes. Okay. First, I have some announcement to make. Uh, so I think we won't have a quiz tomorrow because I think that it is, I can see that some of you may come to the class, may not come to the class, and some of you may listen all the time. Some of you have just learned something. Some of you may just started to be interested in some of the issue we discussed in class, but I think it is probably better for you guys to have time to revise, to study a little bit. So what I'm planning to do is I gonna ask the CFVG office to prepare a session to organize a quiz or exam session that we're gonna be super short, but I would like to take it like make it in few weeks. It depends on the time they can organize. Okay, I will contact them and then ask them to organize the exam sessions. So I decided to make something simple, very simple. Is a kind of quiz that something simple can be probably, for example, 2 or 4 questions. Okay, so that um, tomorrow you will not have exam. Okay, I would like to ask CFVG to organize a separate one, maybe 1 or 2 weeks from now. Okay, 2 weeks, depend on the date. So that I would like you to a little bit make a short revision. Okay, and I gonna make simple exam just to check your concept. Okay, so that you're gonna have time to prepare. Okay, because I know that if I do it tomorrow, some of you may be very busy over the week, and some of you may not be ready for tomorrow. You won't have time to prepare or read it today. So I just leave your time to revise the materials, the issue we discussed together, and maybe in few weeks you're gonna come and write this exam. Okay. And the exam, as I told you, I gonna make very simple. It's can probably 30 minutes or 1 hour. Maybe 30 minutes is good enough. Maybe I gonna make like 20 true and false conceptual question to ask you. I don't know, something very stupid. But the I would propose, if you don't mind, to make simple but closed book, because if I make the open book, I need to make it more difficult. If open book, it's gonna be more difficult. Or if closed book, easier. For example, true and false questions. Which one do you prefer? You prefer easy, option 1, or option 2? 2? Yes? Everybody agree? We do something simple. Huh? I may ask you, for example, that the advantage of bank debt is long maturity. Okay, the advantage of bank debt is long maturity. How you gonna answer? False. That's it. Something like this. That makes sense? And I can ask you that something very nice like this, that you know, the project want to issue bond, were able to issue bond in the Rule 144A market because the bond got a rating of events made grade rating. The project were able to issue bond in the Rule 144A market because the bond got an investment grade rating. How do you answer this? True or false? No, it's false. Why is false? Because the Rule 144 market, you can also issue at D or lower investment grade rating. Why they want to go for investment grade bond rating? The main benefit to issue bond with investment grade rating is to lower cost of debt. It is true or false? The main benefit to issue bond with investment grade rating is to lower cost of debt. True, right? Because they want to lower their cost of debt. Yesterday we estimate is almost 25 basis point. They can probably save the money, okay, because they can go. This is the marginal benefits is about 250 basis point, right? Because we compare the bond with the B rating compared to the bond of triple B minus rating. You follow? This kind of revision that you should make. I think the previous question is kind of hard for closed book because it would not demonstrate the condition. Yeah, but don't worry, I don't have many question like that, but just maybe one or two to let you think about it. Okay, let you interpret it. That makes sense? Okay, so but the idea is about this one. I would like to, to understand. They have some of the issues that is very related to cases, a lot of things. Maybe I would not have some kind of big calculation that you see in the problem set, because I want to make simple. Okay. So the problem set, you do it for learning, but I can probably have one or two questions related to the concept that you learn about, relative PPP or absolute PPP and something like that. You revise, but I would not make a very big calculation. If I have to have a small, simple calculation, I give you formula next to that one. Okay, the formula will be given. Okay, that makes sense? Yeah, good. Okay, uh, good. Okay, we make simple, and we're gonna make shot, I would think about 30 or 1 hour maximum to have maybe 20 um, or more than. I don't know. I haven't written yet. And then you're allowed to come to the university now, right? Or you have to do it online? Are you allowed to come to CFVG to write exam? Yes, do online. But are you allowed to come, or I have to do the online version? I see with them. Whether you do the online, because the online with closed book is complicated, no? Not allowed to come to university until now. I think it's better to do online version. Okay, but have you done any online version with closed book? How can you control that is student don't search anything online? I will see. Because last year or the year before, or your capital structure, right? You came to write. Okay, I will check and then I will get back to you, okay? What the best to offer you the best solution without cheating. Okay, perfect. So, have you had time to have your Excel spreadsheet? You have time to do your Excel spreadsheet like this? Tuk, tuk, tuk. So, this is an Excel spreadsheet that you should have, right? The one that highlights. You have those kind of Excel spreadsheet? Yes? Yeah, I believe you. I trust all students. I trust your honesty. But sometimes students don't trust themselves. I trust you guys. I trust all my students, but just sometimes the student don't trust themselves, so they want to get more comfort from friends. Like, okay, so I always trust you guys. Don't worry. As I told you, I gonna ask that if everybody participate, come to the class in a convert, you have already 3 points. Okay, it means like if you get 9 in your final exam, I let you get 10. Okay, if you get 19, I give you 19.5, something like that. Okay, so all right. So do you have Excel spreadsheet? Yes, no. Can I trust you? You have it, or you don't have it? Do you have? Yeah, we do. Perfect. Okay, before we go to the Excel spreadsheet, you can see from my Excel spreadsheet, we can play a lot of things in this spreadsheet, okay, to do different kind of simulation and interesting analysis on that, okay? But before we go for that, I would like to go to the another questions on how you identify the project risk. Okay, so if I take the risk, let me take it. How you handle this kind of question in the real world? Like if somebody asks you, can you identify your major project risk? how you start? How you gonna start? How you start your analysis? So like my capital structure, you first read and then you write. You don't know how to write, you reread and try to write. So when someone, you have real cases, hello, Duke, Lim, Bill, you're driving? You're very innovative, huh? Learning by driving. It's gonna be dangerous, isn't it? That's good. You're still in the car, right? Another person may be on the motorbike, and then you study with me with your motorbike. Super dangerous, no? Good. So, how you handle this? If you someone asks you, they give you the project, they use you are the big finance managers. When someone asks you something, you take the information. Like last time we discussed, you read the financial statements, okay, of the company, and then you try to understand. In the balance sheet, very easy to understand. You look like at the left hand side and you look at the right hand side. The first thing that you can see when you look at the balance sheet, what is the balance sheet tells you? The balance sheet is like you go out from the company and take your cell phone, right? And you make a selfie of the company, right? Like you go out from the company. It's like you take your phone, you want to take your selfie, right? You smile, big smile, and so on, right? The balance sheet is like that. It's one snapshot of the information you can learn from the company, right? So in this snapshot, they always have these kind of things where this one tell you some things that the company is look like this, or company is look like this, or company is our company looks like this, right? The shape of the balance sheet tell us the capital structure, and then you can analyze whether the A they contain a lot of fixed asset, intangible asset, they have a lot of long-term maturity, short-term maturity, how they manage their working capital, which are account receivable, inventory, and account payable, things like that. Okay, so you analyze the balance sheet in the form of static, right? And another analysis that you look, and we looked at yesterday together, we are interested about what? About the flow of the cash flows, right? Where the flow of the cash flows, they come from the operation of the A that would generate the cash flows. They generate from what? From from what? From sales, and then cost of goods sold, and then SG&A, and then what? What you get? You get you get, for example, the EBITDA, right? You got profit, your sale minus cost of goods sold, you get gross profit, sell and G&A, EBITDA, and then you minus the. After I minus that, you get EBIT. After you pay IT, you pay I, and then you pay, and then you get earning before tax, and then you pay tax, and then you get net income, isn't it? So this one we called it as the, how we call this one? This one we called it as the income statement, right? So this income statement, okay, show you, okay, how the cash flows look like. Yeah. So meaning that if I have this, okay, the one that we are interested in, okay, that people say that is about EBIT, maybe it's okay, but you know that the DA here is not the a real cash flow. What we are probably interested is about these cash flows, and we're gonna try to see that how close of the blue EBITDA, okay, we're gonna cover the the to pay the I, right? So if I make let me, what can I do? So we're gonna be able to find out, or we are interested in, when you are the um should this, okay, let's take this one. So this is how close of your ABDI, or earning before interest and tax, and before depreciation and amortizations, kind of EBITDA. In our case, we're gonna do some real cash flows, that available cash available for before the debt service, right? But in your income statement, you can look at the EBITDA over I here to compute, to find out. This one we call interest coverage ratios, okay, where you can have a look at this. In our case, we're gonna do something related to the debt service coverage ratios, or the DSCR. Okay, why we are interested about DSCR? DSCR, we are interested about how far, how close of the, the is a proxy of the probability to whether or not the company will not have enough cash flow to pay that debt service, right? So it's a proxy of default risk, for example. Everybody know what the proxy means? Everybody know what the proxy means? In finance, we do a lot of proxy. Okay, I told you already. If I want to know, for example, to compute the RWAC, what is the RWAC? What is the RWAC? It's a proxy of what? Why we compute the RWAC? What is the WAC? What is the WAC? WAC is weighted average cost of capital, right? We use the RWAC as a proxy of why we compute the RWAC. We want to do in the discount free cash flow, but what is the proxy? Why? What is the RWAC? We use it is a proxy of what? Everybody understand the proxy, right? A proxy is if you don't know to measure in real world, in corporate world, in finance, even finance, it's very difficult to measure many things. Okay, when you don't know how to measure something, for example, you want to know what is the level of systematic risk of a stock. What is a systematic risk of income? How you use the proxy of systematic risk of income stock? What is the proxy of systematic risk of income? No? you want to compare with Viet Bank or whatever, so you want to measure the systematic risk. How you gonna measure systematic risk? Systematic is the proxy of default. Blam blam blam. Nguyen Hong Lin Hui, you dead. No. Systematic risk is completely different from the default risk, right? Are you sure you did capital structure, the finance course? No? Did you study a little bit? Yeah. Okay. You don't know how to measure systematic risk? Do you know how to measure the stock volatility? Do you know stock volatility? Volatility. How are you gonna measure stock volatility? You know what is stock volatility? Yes. What is the stock volatility? No. Stock volatility is measure systematic risk? No. Volatility is measure of systematic risk? Yes, no. Give me the nice answer, please. No. Okay. What is the how you measure volatility of stock? You know how to measure volatility of stock? Which is completely new to you. You have never heard anything about the term volatility. Yeah, thank you, Tichen Deng Guyan. So you take, for example, the standard deviation of a stock return, okay, as a proxy of the total risk that we use it to measure volatility, right? Volatility just measure how the stock returns fluctuated, okay? So form from the mean, right? So you have the expected returns, you have the historical return, and you compute the standard deviation of those returns. You're gonna get a measure we call the volatility of a stock. And we use volatility of stock as a proxy of the total risk, okay? And we know that in these total risk, we have two components of total risk, at least in the simple capital asset pricing model. We do that. They have something which is diversifiable and something uh, undiversifiable, right? So diversifiables are the risk that can go away. It's called the idiosyncratic risk or unsystematic risk or firm specific risk, right? That is specific to that stock, okay? And we know that when you combine several stock, risky stock together in the portfolios, okay? So if you form a risky stocks, and we know that some of the risk, particular the firm specific risk, can be eliminated, can be diversified away, right? The risk that cannot diversify away, we call it as the non-diversifiable risk, or we call systematic risk or market risk. Is it new to you guys? No. Did you take your capital structure class with me? Yes, you just enjoyed the Eiffel Tower. You forgot everything. You just remember my Eiffel Tower from my window and you forgot all the concept we learned. Yes. Yes, no, some of them smiling. So how you measure the systematic, how I can quantify the market risk? I quantify the volatility by measuring the standard deviation. How can I measure systematic risk or market risk of a firm, of a stock? Please, example, how you measure market risk or systematic risk? Beta. Thank you. Okay, you measure the beta. The beta should represent the, or we use the beta as a proxy of market risk, right? So having high, a stock who has the higher beta means the stock that has higher market risk. Okay, so therefore we use the CAPM to find out what is the risk premium that you would require to compensate of the level of market risk you take. We say that we're gonna, measure the expected returns, or required rate of returns of the to the stockholders equal to the risk-free rate plus the beta multiplied by what? By expected returns of the market minus, or the market risk premium, right? So we have the market risk premium. You multiply by the beta, you're gonna know what is the risk premium for that stock. Everything is okay? You follow this? Everybody know the CAPM? Yes? Hopefully. Yes. Everybody know this? Yes. Okay. After you explain, I know. Okay. So we measure the beta. We multiply my market risk premium. Market risk premium is the expected return on the market portfolio minus the risk-free rate. You're gonna be able to quantify the estimated risk premium above the RF. You know that it should represent the required rate of returns that the investor should require in holding these market risk. Okay, so therefore, a stock that has a higher beta should have a higher expected return. And we use the CAPM to estimate the expected return of the stock I, and this ERI is a proxy of what? We use the ERI in the corporate world as a proxy of what? After you compute the beta, after you compute the expected returns, so how that is come to your picture as the CFO of the company? We use the ERI as a proxy of what? Anyone? You can talk also, huh? You can take the microphone and talk. Guyan, Hong, Leon, B, you dead. ERI is a cause of death, you dead. I kill you. Anyone? Duke Liam B, you are in the same place, you driving? Can you tell me what is, I should not ask you because I don't want you to have an accident. I ask someone else. What is the ERI is a proxy of what? Anyone can help me to answer this? You did very well in my exam. I remember all these are not new, but it's long time ago, sir. You all returned to me. No, don't forget. I am in car, not drive. Ah, okay. You just in car, but you don't drive. That's good. So what the ERI is a proxy of what? It's a proxy of what? In investment decision, for example, in the project finance, we're going to discuss today and tomorrow, we try to estimate the RWAC of the project company. Okay, we calculate, we compute the beta by using several, stocks of comparable firms, and then they get some kind of idea of the beta. And after we get the beta, we compute the expected returns to the equity holder. So it's a thank you, T. Kim Hong Long. We're gonna use the ERI as a proxy of cost of equity capital, okay, or the RE. Everybody agree? Everybody follow me? Yes? Okay. We use the CAPM to estimate the cost of equity or capital of firms. Okay, and then we use how you measure the RD. What is the RD? Cost of debt capital, right? We are estimate cost of debt capital. Okay, of the RD we can use, for example, that the RD can be equal to the yield minus the PL, or we can use an approximate term for some yields of the bond as the cost of debt capital. Okay, if the probability default is uh, is small. Okay, so all these we have already studied it in my capital structure class, I guess, no? So, and then you, after you have the RD, you take the D over D plus E multiplied by 1 minus tax plus E over D plus E multiplied by RE. I will not write it, huh? I know that you know this, right? We know the RWAC, weighted average cost of capital, okay, by take the D over D plus E, right? And then you multiply by RD, okay, multiplied by 1 minus tax rate plus what? E over E plus E multiplied by the RE, right? Something like this, okay? That is how we compute the RWAC, okay? And what is the RWAC is proxy of what? RWAC is a proxy of what? Why we compute the RWAC, weighted average cost of capital? Because we want to know what is required rate of return with a similar risk of is estimate as what, right? So we use the RWAC is a proxy as a proxy of what? You use the ERI as a proxy of cost of equity capital. You use the yield of the bond as a proxy of cost of debt. And now you use the RWAC as a proxy of interest rate to calculate value of enterprise cost of firm capital. You're perfect. Okay. Cost of firm capital or company cost of capital, you use the RWAC as a proxy of the RA, or the asset. The company hold the risky asset on the left hand side, isn't it? Okay, instead of, if I show you this, okay, so if I have my RD here, I have my RE here, I gonna be able to compute my RWAC, and after I get the RWAC, I use it on the right hand side as a proxy of my RA. Okay, everybody follow me? So RD represent the cost of debt based on the risk that this debt holder holds, right? The debt holder does not bear the same risk as the equity holders. The equity holder require the RE, the cost of equity capital, to respond that correspond to the risk as the equity holder. The RD represent the required rate of return, the cost of debt capital, and you compute that on average, or the weighted average cost of capital on the right hand side based on the proportion of the D and the E to get the RWAC, and this RWAC we use it as a proxy of the RA of the whole company. So we use RWAC as a proxy of the firm cost of capital or company cost of capital. Is this okay? Yes, it's good revision, no? I feel like you lost some translation or somewhere, okay? But it's not completely new. You have studied already, but please careful on terminology that you use. In finance, it's very specific and very, precise. Try to avoid the term of interest rate, because if you use interest rate is very large, sometimes you can use it from time to time, but don't use it automatically, because the discount rate, the cost of debt capital, cost of equity capital, you can use it at interest rate, but it's not interest rate, right? Because the cost of debt capital is not the interest rate, it's the yield, and even the interest rate is not the same as the coupon rate. Interest rate can mean so many things. Sometimes it's right, sometimes it's wrong, but what we're talking about here, all the discount rate, the company cost of capital, and RWAC, RA, and so on and so forth. Somebody said that you're going to use the RWAC as a proxy of the RA when you do valuation of firms, right? When you do the valuation of stock, you're going to use the cost of equity capital. When you do valuation of bond, you're going to use the cost of debt, because bond is a debt part and the stock is the equity part. And when you use the firm free cash flow, you're going to use the RWAC. Okay, my last question before we go, if I have a project that I'm consider, can I use the RWAC of the company to discount my project's free cash flows? Everybody know what is the difference between project free cash flows and firm free cash flows? Yes, the project free cash flow is the free cash flows available to the project owners, right? So you are focusing on only the project. You're gonna discount those project free cash flow to compute your NPV by using the project's cost of capital. Is it the same as a firm cost of capital? Is the same? Not the same. Thank you. Why is not the same? Because the project risk is not the same as the firm risk. But sometimes if you estimate that the project risk is the same as the company risk, and then you can use the company firm cost of capital as the proxy of the project cost of capital. But in most cases, it's not necessarily true, right? Because company hold several different projects in their assets. Your new project, if you don't assume that it is the same as the average total portfolio of project that the company holds, that case, assuming that the project cost of capital equal to the firm cost of capital is wrong. Everybody know this? Yes, the project cost of capital represent what is the opportunity cost of capital, represent the risk of the project that the investor should earn. Okay, so it depends. If cost of that project is estimated to be the same of firm capital, right? So far, so good. In our estimation of Petro Suwata, we're gonna have this problematic, right? Because if you are the question is very simple. If you are Konoko shareholders, are you all going to invest in the projects or not? See, as the CEO of the company or the shareholders of the company, you invest or not invest. You go or not go. How I can make this decision? Not easy, but we're gonna do it together to understand this. Okay, but before we go for that, we want to know first, if you are S&P, are you going to give triple B minus? If you go to New York City, you think that you can convince the S&P Standard and Poor to get investment grade rating. You see, the question seems to be simple, but very difficult to answer. How you gonna handle it if you are the CFO, you are the team or project sponsor to convince S&P to get investment grade rating? Okay, so that is the objective of our today class. Okay, how or whether or not you're gonna give the triple B minus. The answer would be you give, you don't give. Can you raise your hand? You give, or you can vote here. You give, yes or no. Say yes, you say no. If you don't know, you say it depends. Yes. You can ask your son whether he gives yes or no. I see your son next to you. My daughter is not far away from me too. She comes to see me from time to time. So you say yes or you say no? Yes, 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 no. I think yes. As far as I know, yes. Is the minimum rating for lending. Is this right? I can ask you a question, huh? You give me the real question. Thank you, Guyan On Liu. I gonna, oops. Give my exam. I said that you give yes because triple B minus is a minimum rating for lending. Is it true or false? It's true or false? I see you smiling. It's true or false? You're smiling and you said false. So not necessary, right? So you can have a B, you can have C, you can have anything, right? So that one is false statement. So triple B minus is not a minimum rating for lending, but the company don't want to get lower than triple B minus. The project doesn't want to get lower than triple B minus. Why? Why they don't want to get lower rating? Why they don't want to get the lower rating? Why the project does not want to get a lower rating? Even they can, because it gonna higher their cost of debt capital. Perfect. I love you guys. So you precise more and more. We should stay from time to time, once a month, and some small short course so that I correct, I review, I revise some of the concept we learned together. No, after a few days, I feel like you do better now, a little bit more precise, more conceptual, which it shows that you have good, well training in finance with the CFVG or with your professors. Should get your degree of MEBF immediately. No? So low rating means higher cost of debt. Perfect. Okay. So is there minimum rating for lending? No, there's no minimum. But obviously, if you're planning to get the D rating, and sometimes it's not worthwhile to issue bond to get D rating because you're gonna pay a super high, yield, and then maybe you have less investor base. Because the thing is, when you go to the capital market, is also the question of demand and supply. Is it true that some rating, okay, some investor they cannot invest? For example, if you discuss with the pension fund managers, everybody know what the pension fund managers. So the fund manager who manage for pensions, for retirements of the old people, they may have some restriction that to ensure that these pension they would have enough money to pay pensions to the people in the program. Most of those pension fund manager they may have some restriction to invest only investment grade rating because the risk profile they can take is different. Yeah. However, if you are interested and working for the hedge funds, some of the hedge fund they don't care. They like those kind of high speculative, bonds or the high yield bonds with low rating because they search by definition they are seeking for high return investment, but they have also capacity to bear the high risk. That makes sense? So if you work for a bank, if you work for the pension funds, if you work for your big boss, if you work for some of those people, or you work by yourself at some stage of life when you are young, single, your risk profile may be different. Now you're a mom, you have two kids, you may think differently than 5 years ago because you don't want to, you want to ensure that you manage your financial asset in such a way that the risk that you can bear, the level of the risk you can take correspond to your objective. So therefore, there is no such an absolute answer which level you want to go, you should go. Everything is depends, right? Insurance company and any leasing company, corporation, very big investor, angels, the venture capital, private equities. Each one has different risk profile to bear different risks, and expect different returns based on their, what we call risk preferences. Am I correct that the rating is more for cost of debt? Different institution could apply different method of cost of debt, right? Yes. So the if you go and you take some of those, financial modeling to estimate cost of debt, or to basically you can have the credit risk model, some sophisticated rating agency or some sophisticated banks, they may have their own credit risk to, estimate the default risk. They sometimes they can use some big data of the borrower historical payment history to identify, to be able to come up with the interesting model that help to predict that if you have this kind of information, it help you to predict the likelihood or the credit risk that that person compared to another person, and then how you gonna price the premium to compensate the credit risk. The credit risk model is depends a lot on institutions that they use, and they never show you what is the model they use, because each one may plug different factors and put on it. And most of those sophisticated insurance company, sophisticated financial institutions, they have their own credit risk model to estimate. Today we're going to do some basic, simple, model to evaluate the level of credit risk that help us to identify whether or not you're gonna give triple B minus rating. Okay. Now, if you are the debt holder, you are the rating agency, you are interested about what? Stock volatility? You are interested about beta, or you are interested what? When you are the debt holders, you are interested about growth? Are you sure? What you are interested in when you are the debt holder? What is the role of the debt holders? The debt holders, you lend the money to someone who borrow you, isn't it? Okay. When you issue bonds, right? You are the bond holder. You expect to get what? Get to pay coupons and face value at maturity, right? The face value at maturity, right? When you buy a bond, you become a bond holder, you expect to receive coupons that indicated on the bond and face value at maturity, almost like the bank loans that it make your life easier. So loans, bonds are the same thing, right? The loan is the debt instruments, it's a debt contract you sign with the bank, where when you issue bond, you also lend the money to the bond issuer, like you give the loan or the bank give the loan. Just the bondholder lend the money to the issuers, isn't it? Right? So if you are banks, you lend the bank, or you make the bank debt, what you expect is to get interest. The banks we often call interest, and right when you give a bank a loan, what you expect to get when you lend the money, you give loans to the borrowers, you expect to get interest and the principal, okay, on what they promised to pay you. So you are the bank lenders. You're gonna try to make the debt schedules that match well with the capacity of the borrower who gonna pay back the interest on time and principal on time. Can design your principal with the amortization that starting every month, the borrower can reduce your principal on time because you calculate the annuity of monthly everything fixed per month when you get mortgage. Very simple. But if you go to lend the money for big corporation, you can design any maturity you compute to such a way that you want to ensure that the borrower will not default their debt obligation, their debt service. We call the debt service. And this debt service represent part of it on interest or coupons if the bond and the face value or the principal repayment to the lender on time, right? Because you want to avoid any extra cost that go to you as the lender if the borrower default their debt obligations, right? Such as distress costs, you have to monitor, you have to call them, you have to negotiate. It's very costly. You try to avoid this, yeah? But if something happened, you have to negotiate, you have to discuss, right? From the perspective of the debt holders, okay, you expect that the cash flows that gonna use to service that debt obligation should be high enough to compensate, the risk that you take, or at least the high enough or low enough that you can price that risk. Okay, you price the risk based on, for example, the spread that you're gonna charge them on the loans, right? So for example, if you use the international term, you're gonna charge LIBOR plus 300 basis point to your borrowers on the loan. So you are that the debt holder, you're gonna define whether I should as them to pay 200 basis point or 300 basis point above a benchmark rate, right? You can use prime rate in local Vietnamese prime rate, or you can use LIBOR, you can use SIBOR, you can use many other things. Everybody know what the LIBOR is? Everybody knows what, when you do some international loan, for example, you lend the money to big corporation in US dollar. Okay, so you not necessarily need to use those local benchmark rate, right? So somebody can tell what is a LIBOR? Anyone work in the bank? Yes, many of them, many of you. What you are doing in the bank? Sit down, drink bubble tea? No? What is your service to do? I'm joking, huh? So what is the LIBOR? Anyone know? London Interbank Offer Rate. Why we use the LIBOR? What is the LIBOR is using for? We use it as the average lending rate to good company of top banks in London. We use this as the benchmark rate, right? So you can use the benchmark rate to price the loan, like you do the CAPM, you use the risk-free rate, you use the T-bill as your benchmark rate, and then you price the risk premium, right? The risk premium of the stock, when you take the CAPM, you use RF plus beta ERM minus RF, but beta multiplied by ERM minus RF is a measure or the calculation of the risk premium correspond to that stock that investor require above the benchmark rate or the risk-free rate in the economy. When you do price the loan, you can charge the customer based on the variable or we call floating rate by using some benchmark, right? You can use if you are local, anyone get the mortgage, what is the lending term on your mortgage loan you get, or what is a conventional typical loan contract in Vietnam, how they price it? They give you a fixed rate. I can give you in France, for example, my apartment here, I borrow the money, I get the mortgage. I can have floating rate, but floating rate is not common for mortgage in France, so we have the fixed rate. So I borrow for 20 years mortgage loans. My fixed rate I pay is 0.95% fixed for 20 years. Good or bad? Very good, no? Wow. So what is the interest rate of mortgage if I want to buy a new apartment or new house, new flat in Vietnam? What is the interest rate if you are good customer, you are prime customer, how much you should pay? Can you give me some idea? First of all, is a fixed or float in general? Resident saving interest rate 24 months plus some margin. Okay, and what is a floating rate, right? And it's floating, and you can see here that the residential saving interest rate is a kind of benchmark rate, right? And then the 4%, that is we call the risk premium, that we price based on specific risk of that customer. That makes sense? When you do Petro Suatar, you're gonna get syndicated loans. Everybody know what the syndicated loans, right? So they can price it as the US reference rate, can be the T-bill or something else. They can use that as a benchmark. Or if you are in Vietnam, you borrow in US dollar by international banks, sometimes they can price you as LIBOR plus something, right? And this something we call the risk premium. Okay, the idea is we're gonna try to price this risk premium, okay, based on a benchmark rate, and the common benchmark rate that people use is the LIBOR, for example, or you can use Singapore or SIBOR on other things. Okay, if you borrow from Japanese government to build the the new airport in Hanoi, where the Japanese government give you a big soft loan with a very low interest rate, and then that is kind of pricing we do is on the debt. Okay, the way we price the risk premium on the debt would gonna be based on something called the risk. Okay, and the risk for the debt holders when you price the mortgage approximately 4% or 3%, 3.5%, based on they price it based on what type of risk? Systematic risk, unsystematic risk, firm specific risk, what type of risk that they are interested in when you are the lender. what is the risk associated to the premium you price on the debt contract? See, the risk can be defined in so many ways, right? My question I ask is, what type of risk, perfect or default risk or the credit risk that we are interested here? Okay, so therefore, we would like to ensure that the risk that you are planning to take as the debt holder, I'm not interested about the total cash flow generated by the project, generated by the company. Obviously, I will understand it. I try to see how the business work and so on and so forth. But the most important one is the cash flows that you are interested available for paying the debt service. That is the most important part for the debt holders. The debt holders interested only or more specifically on the cash flow available to them. Available to them means the cash flow that after they pay the operations, after they pay cost of goods sold, they are available from operation to pay their debt service. That is something that we are interested in. And this cash flow available for debt service in relative to the debt service that they have to do, which can help you to measure the level of default risk or the credit risk. Okay, therefore, in the case we use the DSCR as a proxy of default risk. Everybody follow me? In the real world, when you S&P, they have their own credit risk model to estimate how likely they're gonna default it. But now we can just make a proxy, a rough estimation to see whether the default risk is high or low in comparison with other type of, benchmark or comparable projects that you can evaluate that got a better rating or low, or because when we do a credit rating, okay, so the credit rating is actually is a rating of the level of the credit risk, isn't it? Higher rating mean lower credit risk, right? You agree? Right? If you get a higher rating, it means that you have a low probability of default, isn't it? You have low opportunity default, so therefore the bondholder will require lower risk premium. Therefore, the company will gonna lower their cost of debt capital. Everybody follows? Yes. No? Okay. So now we're gonna use DSCR as a proxy of credit risk or default risk. Okay, do you have, can you use now your Excel spreadsheets and you compute, like gonna first hide this. Just 1 second. So, oh, no, 1 second. One second. I show you something. Okay, let's just me checking something. Oops. I have so to debt, equity cash flow, dividends. Okay. So service, what kind of total service? Oop, total debt service, cash used for debt service. Okay, cash used to debt service. Okay, so cash used to debt service. Okay. All right. So okay. Okay, just let me show you. Okay, can you help me? Can you take your Excel spreadsheet? Can you help me to compute? Do you see my Excel spreadsheet? Yes. Can you help me to compute the DSCR? So if I use my DSCR, example, I use my DSCR. So everybody know how to compute the DSCR? So you cannot compute from this period. You can use the cash for debt service, cash return, cash available for debt service, this line, this column, sorry, and this column, you can able to compute DSCR. Why don't you do it right now for me, please? Can you compute your DSCR? Can you try to compute DSCR in Excel spreadsheet? You can just use the column cash available for debt service that represent the total cash available before they pay debt service. It's almost like EBITDA plus plus, and then you get the total debt from if I take this one, okay, show you this. Okay, so if you have your cash available for debt service here, CADS, okay, and you have the debt service to do, you should be able to compute your DSCR. Okay, you compute all the DSCR and you compute, for example, the average of DSCR. What is the average project of debt service coverage ratios, right? Can you help me? What is your DSCR you get? serve. Everybody know how to get this? Can you tell me what is the average DSCR? I would like to know. Yes, that's right. Debt service coverage ratio is equal to CADS divided by debt service. I would like you to compute the DSCR of the project. So T Kim Hong Lam got 10.62. Everybody get the 10.62? This is correct. This is come from, if you see my slide, I also get 10.62. Normally the SCR is bigger than 1 is acceptable, isn't it? Yes, we're gonna see. If the SCR equal to 1, meaning that is very, very close, isn't it? If you are the debt holders, you would prefer to have bigger than 1. And no one will tell you what it should be the absolute. It should be 2, it should be 10. 10.62 seems to be high or low. Before we go for that, everybody got how you get 10.62? Yes, no? I see someone who said depends, sir, because you don't have Excel spreadsheet. How you get this 10.62? T Kim Hong Lam, T Kim, do you have, are you able to share your spreadsheet? How can you get 10.62? Are you with me? Are you in computer? Can you share your screen? Do I allow you to share the screen? You can share the screen with the, I got same answer. Kuyan Long Liu Bill, do you have your computer? Can you share your spreadsheet with your friends? How can you get 10.62? T Kim Hong Lam, anyone can share your Excel spreadsheet. How can you get 10.62? I don't know how to share screen. Anyone know how to share screen? Me too. Anyone? You know how to share the screen? Do you have a way to share, or you're not allowed to share? Sometimes you're not allowed to share. If you're allowed to share, can you share? Normally at the bottom of your screen, you have something called share screen. You cannot share. Okay. You want me to share? Yes? Okay. So we do not have the privilege. Oh, okay. So let's go. Let me see what I can share with you. Okay. So if I want to have this, okay, so what I can do is I can compute the, where did I get this one? Where's the formula gone? Okay, never mind. So I can just simply take the cash available. So I can have the cash available for this divided by the total service. Why they don't show me? Okay. Okay, with one. Want to take the up. So I can compute only after I can compute. I cannot take the divided by 0. So I have several debt service over a period. Tick, tick, tick. Take it. Ooh. Okay. So I have these column that represent the my cash available for debt service and the total debt service. In total service is in negative, so I take the minus so that I can have the ratio of this positive. If I want to compute my average, so I take the average of is, so I get 10.62, something like this. Yeah, everybody follows? Yes? Yes? Okay, so now let's interpret it. 10.62. 10.62 is high, low, very high, very low. Which one you're gonna answer? High, low, very high, very low. If you are the lender, someone has the debt service cover ratio of 10 times. 10 times of the require of debt service, the cash flow has 10 times bigger on average than the debt requirement. So it is very, very high. Okay, it is very, very, very high. So if I want to get, do I see something on the case? Let me check. This service coverage ratio. Do I have any information on how? Oh, this one probably. See how I can charge rotation. Okay. Everybody can see my screen. Yeah. So if I take the some benchmark in the market by looking at exhibit number 8. Everybody see the exhibit number 8. Everybody can see the exhibit number 8. Can you see my screen on exhibit number 8? Okay. So if you take, for example, this is not exactly the same, but if you take the proxy of EBITDA over interest, you see the EBITDA over interest? Everybody see the EBITDA over interest? EBITDA over interest represent the interest coverage ratio. It's not the same as the SCR completely, but it's close in the sense like we want to see whether the cash flow generate above their interest expenses as the proxy of the level of credit risk. If you look at the company like, you know, PDVSA, Shells, all that. Okay, let's take the US company. You can see that Chevron, Exxon, Mobil, you know, Texaco, Shell. This is a kind of comparable. You can have a look when you are in the real world. You can use the whole company. Many banks, they can have some benchmark to give some credit scoring, some of those. And you can see that 10 is among very high kind of rate or lower credit risk, right? So if you can see the Exxon, who got the triple A bond rating, they get like 15.06 in terms of EBITDA over interest. Okay, Mobile about 16, they got double A. Chevron, they get the double B, double A. As I told you, we don't know how the S&P used or what is the model that S&P used to keep the rating. No one knows. It's a secret, confidential. However, we can compute some of the ratio to get some ideas how likely that the ratio will meet in a way that not only one ratio, but if I just want to pick up one ratio, which is EBITDA over interest, we can see that the EBITDA or the DSCR divided by debt service, which is close to the one that we use EBITDA over interest, right? It's approximate, but it's go closer to that. We can consider that 10 is very high. 10 something is very high. That is how we evaluate this one. Everybody agree? We consider that it is relatively high or quite high. Yeah, 10 times is high. Okay. But if you are the lenders, you are the banks, are you interested about the average? Yes, you are. You think that the average is the most interesting one? 10.62 something, very high. But if you are the bondholder or rating agency or the lenders, what you are interested in? You are interested about average DSCR or you are interested something else? What you're gonna be interested the most? Obviously, you are interested about average DSCR, but maybe the most that you are interested would be what? Would be would be would be what? Would be the year 2008. Why you are interested about the year 2008? Why you are interested about the year 2008 in this cash flow, in this DSCR calculation? Why you are interested about the year 2008? Why you are interested about the year 2008? Why? Why year 2008? Because they give you the lowest DSCR. Why we are interested about lowest? Why lower DSCR is pay your attention? Why? No, it's not about economic crisis. Nothing to do with macroeconomic factor. Just analyzing DSCR. No, it's not the high capex. Why the lowest DSCR should be paid more attention to debt holder? Perfect, Viet Hang Nguyen, because the lowest DSCR is the highest risk of default to the debt holders. The debt holders, when you are the lender, you can apply your risk premium based on the level of highest risk that your customer, your borrower, may default their debt obligation. Everybody follows? Yeah? Because that is the critical point that you are interested the most at the debt holders. And then we know that these 2008 probably the most critical part that you're going to negotiate with the bondholder of this project, how to improve whether or not you are, what the level of the SCR we are talking about here, 2.8, 2.8, 2.08 of the SCR in 2008 is a crucial number that you're gonna negotiate with S&P. You're gonna negotiate when you get the loan because this is the most critical year that gives you the lowest DSCR, that gives you the highest default risk or the credit risk, isn't it? Remember, if you are the debt holder, what you are interested in, you are interested to get the coupons and the face value at maturity. Okay, these debt, okay, they have different type of debt. Okay, some of them they amortize over time. That's why we are interested about the total debt payment we are interested in and the cash flow available to pay the debt service. Okay, you are interested about the in credit risk, and this credit risk you should use the minimum or the lowest DSCR or the highest credit risk scenario. Everybody agree with me? Yes? Do you follow? You follow? So if in case, that is also the question I asked in the case, that if S&P doesn't want to give you triple B minus, they decide you to get only double B. Whatever reason, they give you only double B. Double B is the investment grade bond or it's the high yield bond. Is a high yield bond or investment grade bond? The high yield bond is fine. If a high yield bond, you're gonna pay a higher cost of debt, but you're not happy. You want to get triple B minus. That is your objective. Do you think that what you can do to improve the bond rating from double B, assume that at the moment you get double B, you go to New York City, the S&P believe that the bond can get only double B, and then you fail to get triple B minus as expected. And S&P said, let's go back to us in 3 months time to discuss, or 1 month's time to discuss how you design a project in such a way that you may get triple B minus. What kind of measure you can do to improve your credit risk? Any suggestions? You follow my questions? Now you get double B. They said, please rework on your project and come back with a better scenarios that I would probably consider to give triple B minus. What can you do? Any suggestions? increase cash flows? Can you increase the cash flows? Anyone can take a microphone and talk. I would like to hear your voice. No? Anyone? Chitram Nguyen, can you explain what the increased cash flows you're talking about? Can you turn on your microphone and talk? Yes? Chitram Nguyen, are you here? Can you unmute and talk? What the increased cash flows you're talking about? Can you explain a little bit more? No? Yes?
Oh, sir.
Anyone want to talk?
Oh, sir.
Ah, okay, excellent. Who are
Just,
you?
I have to log out and log in again because that's the process for the canvas.
Ah, okay. Okay.
I'm just thinking that if we have more cash available, then that's also the, the base for the rating. Uh, the how to say that the lender, they base on the rating. They consider our available of cash for paying the debt.
Yes. So, but how are you going to increase the cash flows? How are you going to increase the cash flows? Because the answer very simple. When I ask you this question, right? So the idea that if you want to do the double B to the triple B minus, so assume that you gonna improve, you want to improve your DSCR, right? You want to improve your DSCR, right? So you assume that if you can improve the DSCR, it means you improve the cash flows, the debt service coverage ratios, mean that you have only, how you compute your DSCR, by the way? You compute it by, anyone can write me a formula of DSCR we are computing. Anyone can help me to type how you measure DSCR. Everybody agree with me that to go for double B to triple B minus, how many notches we have to go? Double B plus, and how many notches to go? Let's assume that at the current design, you get already double B. You want to get the triple B minus, how many notches you want to go? What is your double B to double B plus, and then what? You know what my question? Double B plus, and then you get triple B minus, right? You have two notches to go, isn't it? So if I have these two notches to go, I have to improve my DSCR. My DSCR we're gonna have to improve. How I can improve it? So the DSCR, I use the debt cash flow available for service debt divided by the debt service. So you have only numerator and denominator. Either you improve the cash flows available to debt service, or you decrease the debt service, isn't it? You have only two ways to do so. Either you increase your cash flows or you decrease your debt service. And you are particularly interested in particular year of 2008 of your 2.08. You want to improve, increase the DSCR of your 2.08 in 2008. Everybody agree? Yeah. So why don't we have, I need to have a glass of water. Have a bit late to have a break, but why don't we have 10-minute breaks and then we come back in 10 minutes? I need to drink some waters. Yeah, perfect. So we see you in 10 minutes. So everybody back? Okay, how you improved your DSCR? So you're gonna improve the cash flows. How you gonna improve the cash flow? You can increase your revenue. Can you? No, you cannot. It seems like they use the whole capacity to produce oil, and the oil running 24 hours a day. You cannot do anything much on those cash flows. If you look at the Excel spreadsheet, what kind of possibility you can do it? Cash available for debt service. If I look at the spreadsheet here, cash available for debt service. Okay, I will take 10A. Oops. If I have the 10A, I can see that we have the cash available for that service. Okay, so what you can see also that the debt service here, cash available debt service, also have some interesting on the part that the company we got interested about the year before 2008, right? Because we want to improve the cash available for debt service in 2008. So what you can see here, that a big amount of dividend have been paid to the equity holders. Okay, if you keep it for as a cash used for debt service account, you may be able to improve your DSCR in 2008, right? So as you can see here, the lower ratio is come from this period. Okay, so the cash available for debt service can be easily, improve by putting more or pay less dividends during the time when the company makes more cash flows. Okay, that's something you can do. Okay, let's assume that you cannot produce more because the revenue is a maximum. You cannot do some other expenses because they are already, put in place based on operating costs. What we can do is from the cash flow that you pay back to the shareholder too early, very early, you can reduce it. You can use it to make sure that the cash flow available for debt service before they go to pay the equity holder in the form of dividend would be more. That makes sense? What else you can do? You can decrease the debt service. How you can decrease the debt service? How can you decrease the debt service to improve your DSCR? How you improve it? You're gonna decrease the interest payment. You're gonna decrease the principal repayment, right? Can you do something on this? If I take the cash flows from Exhibit 10A, as you can see here, 2005, 2008, you can see here that 2008. Okay, what you can see here, you can see that the total debt decreased over time, isn't it? And it's go from 1.4 billion US dollar, 1.45 billion US dollar in year 2000. And in year 2008, it goes down to 8,850 million. 850 billion compared to 1.45 billion in year 2001. Meaning what? You can rethink and redesign and reschedule the debt repayment. Everybody follows? Yeah, you can extend, you can reschedule not to pay the principal early. Huh? So you have to redesign in such a way that you reschedule some debt repayment, particularly before 2008. If you want to improve the DSCR in 2008, everybody follow me? Yes? In the more radical adjustment you can make, it also you lower your debt, right? If you have less debt, you're gonna have less debt obligation to pay, less interest to pay, meaning that you have to put more equity, right? But that is maybe the equity project sponsor may not be willing to, because if you want to make 60%, you can adjust it to 55% and to see remake the cash flows to ensure that the SCR is improved, right? Because if you have lower leverage, your debt interest payment and principal repayment will also decrease naturally. Okay, but I think I would probably go for the two simple adjustment to, delay or adjust the dividend payments, or I reschedule the debt repayment, right? The principal repayment on my amortize of the loan, right? As you can see that the loan decrease, it means that you repay to the debt holders, particularly on the bank loans. Okay, you can tell and redesign that the bank loan, the debt repayment schedule over the year, starting from year 2001, 2002, or whatever, until 2008, with less debt repayment. Obviously, you're gonna pay more interest, but never mind. But you can reschedule those kind of thing, and that might help you, and it will help you to improve your DSCR. Don't forget that we are interested about DSCR in 2008, which is the critical. Why we are a critical? Because the debt holder is interested about their highest or the point that they have the highest credit risk, because that's the point where they have the highest probability of default. So far, so good. So this is a kind of international debt financings. You see that from the case, we learn a lot of things on how we gonna, evaluate from the view of the credit risk, from the view of the debt holders, how we analyze, how we, find a solution in such a way that we get a better deal, meaning that get the highest rating as possible to lower down the cost of debt capital for the project. Make sense? So if I make all these and then I will uh, be able to look at the case where we have the minimum DSCR, minimum 2008, which is 2.08, average DSCR 10.62 is a good information, but is not the most, interesting, not the most critical one from the view, from the lens of the debt holders. Okay. And then obviously, if you make a different scenario, we call sensitivity analysis, when you change one parameters that would affect the DSCR, you're gonna have, different leverage and how that the minimum DSCR move, and you can see that we are interested about this type of scenarios that can improve your DSCR. If you move it to 55%, your minimum DSCR improved from 2.08 to 2.27. And if you go to 50, it gonna goes up to 2.5. And then obviously at the end of the day is a negotiation between the rating agency and the project sponsor to what level they would accept for triple B minus. So if I get all those, the project 2 week point is about oil price risk and completion guarantee. Uh, that is the probably less important. I have already talking about that the PDVSA would be triple A if it was located in the US. As you can see from those, we're talking about all this already. So how to improve those rating? One that we have not discussed is also that the guarantee of the loan by the Conoco or DuPont, who has a better rating if some of the debt is guaranteed by DuPont, it would help because DuPont got the triple A. Do you think that the guarantee from PDVSA would help to improve the bond rating? Answer, you understand my questions? Does PDVSA guarantee helps improve bond rating? What do you think? PDVSA got what? B. You want to get triple B minus. Any guarantor would be helpful to improve the bond rating only if the guarantor has a better rating than the company, isn't it? DuPont, who has the triple A, if they guarantee the project, it might help to improve. But if you use the PDVSA who got the B, to use as a guarantee of the debt, it will improve or will not improve. it will not improve. The guarantor should have a better rating. If you want to get a mortgage loan, you want to be a guarantee for the mortgage for your elder sister loan, but you have a bad, worse credit rating than your sister, and the bank will not accept you to be a guarantee or interested to have you as a guarantee, because if you have a lower credit risk than your elder sister, okay, the only will be helpful that if your guarantor has a better rating than yourself, right? That is, the bank will be interested in. So therefore, many of infrastructure projects, even is a private or the private public contract, sometimes we add the government to be a guarantor of part of the loan, not maybe entirely, but part of the loan or part of the debt. You can ask the government to guarantee those debt, and that might help because we consider that the government has lower risk than any company in the countries, right? Because the government has power to raise cash flow easily by collecting more taxes. So we consider that the government has a lower risk than any company in the country. So therefore, the guarantee from the government may be helpful. In this case, the guarantee from DuPont may be helpful, but not the guarantee from PDVSA, because PDVSA has a lower rating than the project. That makes sense? Any questions? Yes? No? Perfect, perfect. So, follow, sir, and still not what? Not question. Okay, perfect. It means that you understand everything. Okay, so hopefully, someone has raised your hand, so you can talk now. Oops. What I have to ask you to do now is to read. If you don't read it carefully, the case. So this afternoon, before tomorrow, can you go to exhibit number 11? Can you go to number 11? If you can print it out, note it down. It's very important for our tomorrow class to understand how to estimate international cost of capital. Okay? So would you mind look at these exhibits carefully? Okay, and you note it down how the company estimates cost of capital for the project, how they get the R. So the idea for this, they're gonna compute the RWAC as a proxy of the business firms, okay, by estimating the RE, the KE, by using the CAPM plus SP plus CP, and then you have the estimate of cost of debt, the KD, and after that they get the RWAC, right, which is a kind of the estimate of weighted average cost of capital of the project. Okay. From the view of the debt holders, they estimate the RD. From the view of equity holders of the project sponsor is the KE. And since the company is non-listed company, therefore, you don't know how to compute the beta, how to use the CAPM to get the estimate cost of equity capital. So they use the BA, they use the BE, and then they use Ashland, Tosco, Ultramar, Wallow Energy, and so on and so forth. It's just only one page. Okay. Would you mind reading this page and try to understand beforehand? And tomorrow we can discuss all this. Is another important element that we would like to discuss for tomorrow. It is extremely interesting on how you estimate cost of equity capital in international capital market. It is clear. Everybody know how to read the exhibit number 11, please? Yes? Is it clear? So tomorrow we're gonna learn about how to estimate international cost of capital. Okay, we're gonna learn that if you are the US company, you are interested investing in Venezuela, and how you gonna incorporate and use the discount rate for the US company when they invest in the emerging markets. Okay, so, and this project or this company is non-listed company. So how we estimate the RE if we don't know the beta? So how we gonna use the comparables firms to use as a proxy of the beta, and then you adjust it based on the beta risk of the RA, blah, blah, blah. We're going to discuss all these. You're going to find another extremely useful session tomorrow. Okay. We're going to work on international equity market, okay, or the equity financing. Today, we're talking about debt financing. We analyze a little bit about the credit risk from the perspective of the debt holders. Tomorrow, we're going to focus on equity capital providers, okay, from the view of the shareholder who invests in the project. Do they interested about default risk, or they do interest, they are there interested in other things, okay? And tomorrow we're gonna working on this and try to learn to get some managerial tools or some tools to make this decision whether or not Conoco will invest in this project. Okay, that is the ultimate question, like the ultimate question that we had today, that it seems like there is a possibility to get the triple B minus. Tomorrow, we want to know whether the Conoco shareholder should invest or should not invest in the project. And if they invest, why? Okay. All right. And that's all for today. Do you have any questions before we go? I hope you learned something today. Yes? You learned many things today. I hope. Okay, and tomorrow please read that exhibit number 11 more carefully. Okay, exhibit number 11 would be the heart of our discussion tomorrow. All right, see you tomorrow. Have a nice afternoon and see you tomorrow. Bye.